Chris, it seems like the tax bills, when you look at the details, at least for your industry, generally they keep the retirement contributions intact. So I'm curious how you feel about these tax bills. Are you pretty satisfied with what you've seen?
No, not at all, actually. I'm very concerned because it deals, the House version dealt with a tax called UBTI. It's not very common to most people, but that could impact pension investments. And I'm actually very concerned about how they're treating 401k plans, 457 plans, and 403b. A lot of tax code numbers, but these are defined contribution plans in the USA. And there's a lot of expectations that they'll actually put together a tax plan by the end of the year. And I think that's really questionable in here. So from our perspective right now, we have a lot of questions and need more information. And this is moving way too fast to be able to get that information.
And Chris, are you also surprised there isn't a lot of substance here in tackling carried interest, which, as we heard from President Trump on the campaign trail, I mean, he called carried interest something that hedge funds are using to get away with murder?
Well, we've learned that what was said on the campaign trail doesn't bear a lot of resemblance to what's being said today, which is very frustrating, I'm sure. And I agree. I think that the question of the taxability of carried interest needs to be clarified. They are long-term capital gains in our view. And I think the most important thing from our perspective as a limited partner, how the general partner is taxed absolutely does not change the structure of that transaction. The 2 and 20 model, in our view, is already being broken. It needs to be buried.
Right.
And we need to move to different models. So whether they get taxed on their carried interest or not should be irrelevant to me as a limited partner. That's their tax problem. It is not ours. And I'm going to argue with any general partner who tries to imply there's a linkage back to us.
Okay, and you know, as you say, that 2 and 20 is breaking, and in your view, and you as the CIO of CalSTRS is significant in breaking that model. How much further have you gotten in reducing those fees?
Well, it's incremental. You know, we've already started to see some transactions that go to 1 3/4, 1 1/2. And it really depends on how long-term the capital can be. And we're seeing the carried interest sometimes go as low as 18. But I've said carried interest is a profit margin. It is an incentive for the GP to make money. So I don't mind actually paying a decent amount of carried interest if they make the return over a hurdle rate. It's that management fee that I'm mostly concerned about because that just erodes the capital.
Yeah, you said you've been able to manage those reduced fees. Is this kind of negotiating strategy actually transferable when you take a look at private equity or some of these kind of high fee assets?
I think it is. We already saw it in infrastructure. You know, everybody walks out and grabs the 2 and 20 model. Why not if you're going to go into business? But in infrastructure, that's far too expensive. So we've already broken that down. And nowadays with hedge funds, they have had such, frankly, a lousy decade. Yeah. You've seen more hedge funds be willing to negotiate if they can get some permanence to the capital and to understand why their investor is investing with them, the investment philosophy. Sounds kind of obscure, but really you want to know what that client wants out of you, and that way you know if you're meeting them. They saw too much hot money come in and out and chase returns. And so they're willing to negotiate with serious long-term people. But size is part of the issue. Yeah. You've got to be a large investor. So I feel for the smaller funds. I think they're struggling in their ability to negotiate. Yeah,
talk a little bit about contributions. I mean, what you're getting in right now for CalSTRS is still not quite enough in what you're paying out when it comes to benefits. How does that change overall CalSTRS when it comes to how you're rebalancing your investment decisions? Well,
you hit on the head. We're a very mature plan. So we're over 100 years old. We have more going out in retirement benefits than we have coming in. And that's going to be the case for the next 20 or 30 years. The baby boom is retiring. And so we pay out $500 million a month in outflow. And how that changes in a simple way, instead of being an average cost buyer, we have to be an average cost seller. And so it makes the asset allocation decision. Suddenly cash management is the first thing you talk about in your asset allocation decision.
And you've raised your allocation of cash too recently.
We have, because we think that that's one of the opportunities to be a little bit defensive in this rising equity market. We've made great returns and we're at our market weight in equities, but we want, you know, there's too much risk in the world. We want to be a little defensive as we're moving along.
All right, we might have lost Betty there. She wanted to ask a question, but Chris, stick with us. We're going to get a little bit more, talk about more of your investments in this part of the world, particularly in Japan. Christopher Ailman, all right, looks like we can't get to a break. Let's continue our conversation now. Talk a little bit about Japan in particular, because you've been quite overweight when it comes to this part of the market. What, in terms of catalysts, are you seeing right now? Is it more on this kind of ride that we've seen after this Abe election? You've seen corporate earnings, have seen record profits as well. I mean, what are you seeing as potential green shoots?
Well, we've been investing and I've been investing in different pension plans in Japan since the 80s. So I have lived through the entire cycle. We were very optimistic about Abenomics. And even just this recent election to us was an affirmation. So we think that it's not going to be a rapid GDP period, but we think that Japan is going to continue to improve and grow slowly. And with China being such a large engine of growth, it's going to help all of Asia. So when you look at our world, we've got the USA as a big chunk, half the equity portfolio. And then it's really a question of Europe and UK versus Japan and Asia. We think that the UK is really kind of in a stalemate for a time period with Brexit. We actually are very positive in Europe. We think the recent elections of Macron in France show opportunity for France and Germany to really control the EU and do well. But we really are hoping that we're going to see better growth out of Asia. The yen is a concern. We've been hedging that at time periods, but we like Japan. We like the corporate governance changes. We like that they've modernized the pension plan and allowed it to diversify its investments and get out of debt. Now we need to see the Japanese society open up a little bit, not in immigration, but frankly, I'd like to see them improve the way that women are able to work in the workforce and the way they save, to stop saving in debt and start investing a little bit in equity. And that's going to come with corporate governance improvements.
Chris, I'm glad I'm back online, by the way, so I'm glad you can hear me again. But I'm also glad that
you're back, Betty.
We're on to Asia. And I want to just bring in another reporter here into the conversation because we know that it's going to be a busy week of earnings at Japanese banks. Mitsuo Financial reporting Monday and has perhaps the bleakest outlook of the big three lenders in Japan, according to Bloomberg Intelligence. So let's bring in our Japan banking reporter, Gareth Allen in Tokyo, who's got more. Gareth, what are we looking for in these results from the banks?
Well, yeah, we've been talking to analysts over the last couple of weeks, and the average estimate of their second quarter net income for Mizuho is about 150 billion yen. Now, that's about 35% down to the same quarter last year. Now, the local media have had some reports say they do tend to get leaks on these things from time to time, and they think it might be a little higher, about 180. That's still 20% down year on year. So what's the problem here? Well, it's really the core business. Making loans, taking deposits in Japan has become less and less profitable because of the central bank's negative interest rate policy. It's just squeezing the margins there. Now, on the bright side, Mizuho, we believe their fee income might be a little bit better this time. They've had a few major deals overseas, which might have helped them there. We're also expecting credit costs to be low, and they may even have some big returns with companies like Sharp. Perhaps they'll be able to claw back some reserves there. Big picture, their full-year forecasts are down about 8% compared to last year, but they're about 50% on the way, so more or less on track to get their own targets for the year, albeit conservative.
Right, and what about the fact that we've seen these record, the Nikkei 225 at these records, Japanese stocks are just soaring. I mean, has that helped the banks at all?
Well, it doesn't help their core business very much, but because Japanese banks have these enormous cross-shareholdings, they tend to own shares in their client companies, and there's been a big push with other governments efforts to try and improve governance to get them to sell down these holdings. So we expect that the banks will have sold some shareholdings in this quarter, as they have done in the past few quarters, and that, given the soaring share prices, sort of helped to prop up their income and perhaps even offset some of the problems that they have in their core businesses.
Okay, Gareth, thank you so much. Gareth Allen there on the Japanese banks. And on Japan, I want to bring back Chris Ailman, CalSTRS CIO. Chris, before we dig further into the banks, I'm curious because it's a big question here in the Japanese stock markets is, how much further can we go? Are we witnessing perhaps the start of a correction here in Japanese shares?
Well, Betty, I don't want to use the word correction. It's too tough to predict these markets, but I think we're in what I'll call for a pause. I think all the global markets actually have gotten a bit overheated, just like the USA. This may well be a fairly difficult trading week with, as we're already seeing, a lot more red on the screen than green. The markets have really run in the last, through the summer and into the fall, much faster than I think people expected. So they've gotten a bit ahead of themselves, and I think we're going to see that, I'll call it a pause to refresh.
A pause to refresh. Okay, we'll see. We'll see, right? It takes time to figure out whether we really are in a correction. But in terms of a pause to refresh, in terms of governance issues, we've seen maybe more than a pause, right, Chris? We've seen some of these companies in Japan, whether you're talking about Takata or Kobe Steel or these Japanese banks, in need of corporate governance reform. And I'm curious, from your point of view, again, as the CIO of CalSTRS, how much do you think you can do on corporate governance in Japan? What is your view on what is going on there?
Well, Betty, you know me. I take the long-term view. And we've been at corporate governance in Japan for 2 decades. We've made very incremental gains, but in the last year and a half, I think we've seen some significant improvement. In fact, at the end of this week, I'm going up to Tokyo to meet with Hiro Mizuno and the GPIF pension plan to talk about just global governance. And as long-term shareholders, what can we do to increase the awareness of corporate boards, make them more attentive? I mean, look at Japan. I would not have thought a decade ago that we'd have independent directors starting to be on the Japanese boards. That's huge. Is that a milestone that we expect to repeat over and over? No, it's going to be slow, but that's the first important change that we're starting to see. And I think having people more aware of shareholder return is going to be a huge difference to the Japanese economy and to the Japanese market. That's what would get those savers to start becoming investors, which is what they need long term.